All right, folks, how you doing? Earner Income back today. Recapping kind of the FOMC meeting that happened yesterday, the actions that they took, and what it's going to mean. And I'm going to look at this from a little bit of a different lens, not so much just the consumer, but also the corporation. So first, we can see what did they decide, and it was pretty similar to what everyone was already expecting. If you've been watching any of the news, if you've been on Twitter, if you've been seeing anything. Even if you haven't started out, if you kind of just typing out the Fed and searching things around on Google, you would have noticed that a lot of people were expecting that there's going to be an interest rate hike, that they're currently at 0.25%. They're going to raise by 0.5% to get them to 0.75% interest. Federal funds rate. I did a video 2 days ago describing the federal funds rate. I recommend you check it out. But to summarize, it's the rate that banks have when they want to lend overnight to one another. And the more money it costs bank on interest to lend money to each other to fulfill their deposit rates, their deposit requirements, that trickles over to interest rates on our loans, our credit cards, and all that. It becomes more expensive to borrow money overall. On top of that, so they increased rates to zero, all the way now up to 0.75%. And they noted that this was the first time that you had a 50-point basis hike, a 0.5% hike, since like 2000 or something. Usually they go in increments of 0.25. This one they said 50 because listen, we got to fight inflation. We're going to do more. Some people were saying they're going to go 0.75 per meeting. That has now been greeted with, a little bit of like, I don't think so. But they've said that it might be a little more common. We're seeing more 50 basis point hikes. So keep that in mind. Then they said we're going to unwind our balance sheet, aka they were purchasing a lot of bonds, corporate bonds, government bonds, and mortgage-backed securities at a pretty high rate per month. And they had said that they were going to end it, I think, back in March, although there are some reports that they're still doing it. So keep an eye on where you're getting your research from, what's going on. But now they said officially that starting in June, that they want to do quantitative tightening, which is all those things they bought, they're going to do the opposite. They're going to sell them now. They're going to get rid of their what they have, so at a pace of $30 billion a month for their treasuries, which is their bonds, $17.5 billion a month for mortgage-backed securities. So they're going to sell it, or they're just going to let it mature and it becomes worthless and all that type of stuff. Now, originally, the market had a really good day yesterday. I think it was a 3% after this. And if you were kind of just looking at it from an intraday thing, you'd be saying, okay, it looks like people aren't worried. It's not going to be a big deal. We're going to be able to conquer these seas. Today, it seems like people woke up and are saying, you know what, this is actually going to have some impact. So there's a lot of ways you can go about what this means, what do you think is going to happen, all that. I strictly just want to look at it on the consumer. Most consumers are employed by a corporation, a company, even a small business, of which these changes are going to impact you, and we're going to see how. First, I said that the federal funds rate, when they hike rates, it makes it more expensive to borrow money. In particular, you look at a corporation. Corporations these days are not necessarily funded a lot from their stock prices. They're funded a lot more from corporate bonds, not government bonds, corporate bonds, aka the bonds that they set out, pretty much put open in the market for people to buy. It could be institutions, could be individuals, could be governments, whatever. But they pretty much go to the market, and a company like Apple will say, we want to raise, $10 million. So we're going to issue out a bond, 10 years, $10 million. And if you're going to purchase it, you would give them the $10 million and they would pay you back, whether it's on a structured schedule, it could be once a year, twice a year, 3 times a year, whatever, quarterly, semi-annually, annually, whatever it is. And there's going to be an interest rate on that because you're giving them money now. So they're going to be paying you for that since you're pretty much giving them everything up front. Usually these interest rates have been low. So companies have been able to obtain debt. Now, as I said earlier, they're not most likely going to the stock market. So if the company has their stock price going up or going down or whatever, it's not as big of a deal as what people make it out to be. If the S&P 500, the NASDAQ drops like 20% in a year, that's corporations will be able to go on. Maybe some of them might have a tough time, but most, especially the companies that are hiring a lot of people, it's not going to be as difficult as you all think. Because their operations aren't tied to where their stock price is. Their operations are tied to how easy could they get money from bonds. How easy can they issue corporate bonds and how many buyers are there? When you make it more expensive, when you make a higher interest rate, now is going to be occurring on a corporate bonds, that means companies, when they issue out those bonds, are going to be having to pay more in interest expense. It's an expense that they have not been really paying a lot of because interest rates have been so low. So now in order for them to obtain more money, they're going to have to pay out more money on whatever that structured schedule is, quarterly, semi-annually, annually, whatever. But it becomes a hefty expense when you have an interest rate, when you're issuing out billions in bonds, and a lot of companies are, billions in bonds. And if you're wondering how much there is to issue, I think this year alone there's about like 10 or 20, it's a lot number, trillions of dollars of corporate debt is going to have to be refinanced this year alone. There's I think $1 trillion of global debt overall, and even more money of that, more trillions are within the corporate debt market. The corporate bond market is going to be at the refinance, meaning that there's going to have to be more bonds issued, changes to interest rates and all that. Excuse me. So when you have such a huge amount of debt looking to take a role in this market and the interest rate goes higher, that's a lot of money for companies to pay. And you have a lot of companies that aren't used to paying that. And so how do you make up that money? How do you make up the fact that you have a new expense coming in and you want to keep your margins? You have to cut out a cost. The biggest cost for every company is labor. So there's an idea that if they're going to pay more to obtain money, to obtain loans and all that, and credit more specifically, they're going to be laying people off in order to afford that. And you might be saying, like, how could they do it and all that? Well, the idea is if they can get $10 billion and the result being they would have to fire someone who makes $100,000, you take the deal any day. And that's what is looking like might happen. Now, on top of that, that's just the interest rate. What else does the Federal Reserve say? The Federal Reserve said we're going to be reducing our treasury purchases by $30 billion a month. They have purchased a lot of corporate bonds as well. In particular, I'll leave a link to this article. I remember in June 2020 is when it came out that they were purchasing corporate bonds to help ease the bond market because of COVID, because of stresses, because mainly people were not interested in purchasing corporate bonds. They bought it from a lot of companies that, Verizon, AT&T, Apple, Volkswagen, Toyota, Microsoft. They're saying we're not interested in holding these anymore. We're going to be reducing how much we have, as well as from the government bond side. Government bonds a little bit trickier, but we're going to stick to corporate only today. What does that mean? That means when they came in and originally were purchasing corporate bonds, there was always a buyer of debt. If a company like Toyota wanted to issue out debt, somebody would always be able to give them the money. If they wanted to, if they issued out a $5 million bond, the Federal Reserve was there to give them the $5 million with a very low interest rate. I already told you now that because the interest rate's going up, now Toyota would just be paying back more money in interest expense. But if the Fed is selling those bonds, somebody has to be there to purchase them in order for Toyota to get their money somehow. And that's where it becomes an issue because the Federal Reserve was known as the buyer of last resort. They were always in the market. So people were always in the market because they knew someone was always going to be able to purchase these bonds. Not only are they not in the market now, they're the ones selling, which means who's going to be purchasing these bonds? When Toyota releases new issues, when it issues more debt out, when it says, I want to issue out a $10 million bond, I want $10 million. And the individual who usually was there to purchase it, if nobody was, isn't there anymore. And on the flip side is saying, I don't want to buy it. I'm just looking to actually get rid of what I have from you already. It becomes even tougher because now you're going to be saying, who's going to be able to help these companies obtain the capital that they need and large amounts of capital? And I don't know. And if you're wondering, how can I track this market? There's a couple things I've seen on a couple tickers, a couple stock symbols. These aren't stocks, these are ETFs. These are definitely interesting financial products. I'm not a financial advisor. This is not a recommendation to buy or sell. I don't even touch these things. I just look at them to track. One is called the LQD, and as you see, investment grade corporate bond ETF. There's also the HYG, which is the high yield corporate bond ETF. Don't worry about the yields. Mainly look at the direction. Whenever we've had spikes down, 09, 16, 18, 2020, you all know now. 09 and 2020, those were financial crises. These other ones, 16 and 18, was when the Federal Reserve was looking to make shifts in their economic policies to go to restrictive. Every single time it's dropped. And this is pretty much an indication of interest. When you have low desire, people have low desire to purchase corporate bonds, that's where it gets tough because someone needs to be able to help them. These companies want to refinance, someone has to purchase to help them refinance. What happens when a company can't get access to the money that they want? They're not able to find a buyer for their $10 million. That's where it gets even worse because if you can't find someone to take on your debt so you can continue operations, we're not just talking about layoffs, we're talking about similar to Lehman Brothers, like companies completely failing. Now there's companies like Apple. These companies are all really good that they bought from Volkswagen, AT&T. AT&T is actually a little tougher, but Apple, Verizon, not G, but Microsoft. Like these companies have money on their balance sheets, but not everybody does. Ford especially. I mean, 2 weeks ago they said they're laying people off already, and that's before these changes to their bonds. So CVS I know has been interesting. BP is oil, so they'd be okay, I think. There's other companies we could take a look at. Amgen, DuPont. Disney would be interesting because they're currently losing money on their balance sheets too. So who's going to, people would know the name Disney, but who's going to be taking on their debt? So, and these are just the ones that they were buying. There's a lot of corporations out there that have IPO, that have been in the markets, that have been losing money. That really have been reliant on these, so on issuing bonds out to get debt at a cheap rate. Now they're not going to be able to get it cheaply, and now they might not even have anyone getting it from them. This is kind of a little bit drastic. It's not to say that no one's going to be purchasing them, but the market's going to be thinning out, and there will be an idea of like, if you want to buy a bond, we're just going to buy, Apple or Microsoft because we know that they're doing really well. Why would I buy it from Square? Why would I buy Roku when these companies are losing money as we speak? And there's a better chance that they're not going to pay me back. They're going to default on the loan that I'm giving them. So when that happens, companies have a tough time, and they usually, a greater chance of failing. And in that case, it's not a 20% workforce layoff, it's 100%. So keep that in mind. A lot of these changes have impacts to where you might be working, and what that means for your future. How do you protect yourself from this? It's the same thing I've always said. I'm going to keep saying it. These factors are not in your control. Individuals, consumers, we're not the ones deciding what interest rates are and who's buying bonds. Granted, the Federal Reserve is appointed by Congress, so maybe talk to your local representative, local senator, and be like, what the fudge is going on? But so we can't do anything. The only thing you can really do is provide value to a company, is provide something to a company that makes them want to hire you. And the best thing to do when, we're seeing downtrends, when we're seeing companies try to tighten up their budgets, is to be able to provide a lot of value. I've said before, I work in the tech space. There's always hiring going on for tech. I mean, the other day, I think Google has like 7,000 job openings in tech alone. So that's one place, but sharpening your skills, gaining skills, or becoming even better at what you're at. Quality will always be paid. You either become the best at what you can do, or you offer the most value. So keep that in mind. Start working. Start learning some things, be as productive as you can at work, be as highly valuable as you can at work, and even if they do fire you, you can at least point to them and be like, listen, I'm a freaking master at Excel, I can do this, this, and this, and they'll be like, 100%, we'll hire you then because of what you bring to the table. So it's going to be a huge shift. It is going to be, quality will be rewarded, and you'll see that in the stock market. Quality stocks, companies that make money will be rewarded. Quality individuals will still be hired as well. So that's the breakdown of what happened yesterday, in particular to you. Let me know what you all think. Let me know how you're feeling. I'll leave my Twitter as usual. You can leave some comments, and I'll be back, I think, tomorrow, because we're having job numbers come out tomorrow. So I'll be back tomorrow, maybe talk a little bit about that, and I'll catch you all later and hope you enjoy.